In the summer of 2002, the telecommunications giant WorldCom, once a symbol of aggressive growth, imploded under a staggering revelation. What began as a school bus driver's dream had spiraled into one of the largest corporate frauds in history. The company, a darling of Wall Street, confessed to an $11 billion accounting scandal, sending shockwaves through global financial markets. This wasn't just a misstep, it was a deliberate deception, hidden within the company's books, that erased billions in shareholder value. WorldCom's story is a cautionary tale, revealing the dark side of unchecked ambition and the pursuit of profits at any cost. Before he became a titan of industry, Bernard Ebbers had far humbler beginnings. Born in Canada, he started his career as a high school basketball coach and, famously, a school bus driver. His journey wasn't a direct path to corporate power, it was marked by a series of entrepreneurial ventures, from owning motels to operating a trucking company. These diverse experiences honed a keen business sense and a relentless drive that would eventually propel him to the helm of one of the world's most influential telecommunications firms. This foundation of ambition, however, would also foreshadow his dramatic downfall. In 1983, Ebbers and a group of investors founded Long Distance Discount Services, or LDDS Communications. Their initial strategy was simple: buy unused long-distance network capacity and resell it at competitive rates. This was the infancy of deregulation in the telecom sector, and LDDS capitalized on the burgeoning demand for cheaper calls. Through shrewd acumen and aggressive growth, LDDS expanded rapidly, transforming from a small Mississippi-based reseller into a significant industry player. This early success laid the groundwork for the colossal enterprise that would soon dominate the market and adopt a new, ambitious name, WorldCom. Under Ebbers' leadership, WorldCom embarked on an unprecedented acquisition spree, swallowing up smaller companies and even industry titans. This strategy was the engine of its growth, allowing it to quickly build out its network and customer base. Key acquisitions included UUNet, a major internet backbone provider, and Brooks Fiber. The most ambitious was the 1998 takeover of MCI Communications, then the second-largest long-distance carrier in the United States. These mergers rapidly transformed WorldCom from a regional player into a global telecommunications behemoth, creating what appeared to be an unstoppable force in the burgeoning digital landscape. By the late 1990s and early 2000s, the economic landscape shifted dramatically. The euphoria of the dot-com boom gave way to a painful bust, and the telecommunications sector was hit particularly hard. Overinvestment in fiber optic networks, coupled with dwindling demand as many internet startups failed, led to a severe downturn. WorldCom, having expanded aggressively, found its core business of long-distance calls declining rapidly. The company's revenues began to stagnate and even fall, putting immense pressure on Ebbers and his executive team to maintain the illusion of growth that Wall Street had come to expect. Facing declining revenues and a skeptical market, Bernard Ebbers and WorldCom's senior management were under tremendous pressure to deliver impressive financial results. Ebbers had cultivated a persona as a maverick leader who could always deliver, and the company's stock price had soared under his guidance. Maintaining this growth trajectory, even in a contracting market, became paramount. The desire to meet earnings targets and keep investor confidence high led to increasingly desperate measures. This pressure created an environment where ethical lines were blurred, paving the way for the accounting manipulations that would ultimately bring the entire empire crashing down. To combat the stark reality of declining profitability, WorldCom's executives began to engage in fraudulent accounting practices. The core deception involved reclassifying everyday operating expenses as capital expenditures. In a telecom company, line costs, fees paid to other networks, are a significant operating expense, typically expensed in the quarter they occur. By moving these costs onto the balance sheet as long-term assets, the company could artificially inflate its profits and assets, making the business appear far healthier than it was. This was the critical first step in an elaborate scheme to deceive investors and analysts. To grasp the WorldCom fraud, it's crucial to understand the distinction between operating expenses and capital expenditures. Operating expenses are the costs of running a business day-to-day, like salaries, rent, and line costs. They are expensed immediately, directly impacting quarterly profits. Capital expenditures, conversely, are investments in long-term assets whose costs are spread out over many years through depreciation. By treating immediate operating expenses as long-term investments, WorldCom delayed recognizing billions in costs, thereby fabricating massive, non-existent profits for an extended period, misleading everyone from shareholders to regulators. What began as a questionable accounting practice quickly spiraled into a monumental fraud. From 1999 to 2002, WorldCom's executives, including CFO Scott Sullivan and controller David Myers, systematically manipulated the books. The amount of improperly capitalized line costs grew with each passing quarter, reaching billions of dollars. This wasn't a one-time error but a sustained campaign of deception, requiring active concealment and falsification of records. The sheer magnitude of the fraud was staggering, ultimately totaling $11 billion in hidden expenses. This continuous misrepresentation painted a false picture of profitability and stability. Amidst the widespread deception, an unlikely hero emerged: Cynthia Cooper, WorldCom's vice president of internal audit. A quiet, diligent accountant, Cooper initially became suspicious of irregularities during routine audits. She noticed unusual journal entries and a general lack of transparency in certain departments, particularly concerning capital expenditures. Her instincts told her that something was deeply amiss. Despite potential personal and professional risks, Cooper felt compelled to investigate further, driven by her professional integrity and a growing unease about the company's financial practices. Her methodical approach would prove crucial in unraveling this complex corporate fraud. Despite facing resistance and veiled threats from higher-ranking executives, Cynthia Cooper secretly launched her own investigation. She and her small team worked late nights, meticulously sifting through WorldCom's accounting records, scrutinizing every suspicious entry. They discovered that the company was using an account known as the corporate unallocated account to improperly move line costs. When questioned, CFO Scott Sullivan allegedly refused to provide detailed documentation, further solidifying Cooper's suspicions. The atmosphere within the company became increasingly tense, as Cooper continued her relentless pursuit of the truth, knowing her findings could have catastrophic implications. By June 2002, Cynthia Cooper had gathered undeniable evidence of widespread fraud. She bypassed her direct superiors, who she suspected were involved, and reported her findings directly to the chairman of WorldCom's audit committee, Max Bobbitt. Her presentation was comprehensive, detailing billions in improperly accounted expenses. Facing irrefutable proof, the company's external auditors, KPMG, immediately withdrew their previous audit opinions. The gravity of the situation became clear: WorldCom had been systematically deceiving the public for years. This moment marked the beginning of the end for the telecom giant, as the truth could no longer be contained. On June 25, 2002, WorldCom publicly announced that it had discovered approximately $3.8 billion in fraudulent accounting entries. This figure was just the initial estimate, and it would balloon significantly as the investigation continued. The revelation sent shockwaves through the financial world, immediately wiping out billions in shareholder value. WorldCom's stock plummeted, and trading was halted. The once mighty company, a pillar of the rapidly evolving internet economy, was suddenly exposed as a house of cards built on deceptive numbers. The public confession confirmed the worst fears of many and ignited a firestorm of public outrage and investor panic. Weeks before the public announcement, Bernard Ebbers had already resigned as CEO of WorldCom in April 2002, under pressure from the board and lenders. Initially, he maintained his innocence, claiming ignorance of the accounting manipulations. However, as the scale of the fraud became undeniable, the focus shifted to accountability. In August 2002, the Securities and Exchange Commission filed civil fraud charges against WorldCom. The Department of Justice followed with criminal charges against key executives, including Ebbers. His journey from school bus driver to billionaire CEO had taken a sharp, irreversible turn towards a legal battle for his freedom. Less than a month after the fraud was revealed, WorldCom filed for Chapter 11 bankruptcy protection on July 21, 2002. With $32 billion in liabilities, it was the largest bankruptcy filing in U.S. history, dwarfing even Enron's collapse. The impact was devastating. Tens of thousands of employees lost their jobs, and countless investors saw their retirement savings vanish. The ripple effects were felt across the entire telecommunications industry and the broader financial markets, highlighting the profound systemic risks of such massive corporate deception. The magnitude of the financial ruin was truly unprecedented. Following the bankruptcy, a series of intense legal proceedings began. WorldCom's former chief financial officer, Scott Sullivan, became a key figure, cooperating with prosecutors and pleading guilty to fraud and conspiracy. Other executives, including Controller David Myers and Director of General Accounting Buford Yates, also entered guilty pleas, testifying against Ebbers. The trial shed light on the inner workings of the fraudulent scheme, revealing how the deceptive entries were made and concealed. These proceedings underscored the severe consequences awaiting those who engaged in corporate malfeasance, with each testimony painting a clearer picture of systemic corruption. Bernard Ebbers' trial began in January 2005. Despite his defense arguing he was unaware of the fraud and merely a victim of an overzealous CFO, evidence from prosecutors, including testimony from former subordinates, proved compelling. On March 15, 2005, Ebbers was found guilty on all 9 counts of fraud, conspiracy, and false filings. In July 2005, he was sentenced to 25 years in federal prison, effectively a life sentence for the then 63-year-old. Ebbers served over 13 years before compassionate release due to declining health, passing away shortly after in 2020. His conviction sent a powerful message about corporate accountability. In the wake of its staggering bankruptcy, WorldCom embarked on a torturous journey of restructuring. The company emerged from bankruptcy in 2004, shedding its tarnished name and rebranding itself as MCI Incorporated. It attempted to rebuild its reputation and business under new leadership and stricter ethical guidelines. However, the shadow of the scandal proved too long. In 2005, MCI Incorporated was acquired by Verizon Communications for $6.7 billion, and the WorldCom/MCI name effectively ceased to exist as an independent entity. What was once a global telecommunications powerhouse was fully absorbed, its identity erased, serving as a permanent reminder of its spectacular fall from grace. Cynthia Cooper's courageous actions did not go unnoticed. For her role in exposing the WorldCom fraud, she was named one of 3 Persons of the Year by Time magazine in 2002. Her story became a beacon for corporate whistleblowers and highlighted the critical importance of internal controls and ethical leadership. Her work, alongside other major scandals of the era like Enron, directly contributed to the passage of the Sarbanes-Oxley Act of 2002, a landmark piece of legislation designed to improve corporate governance and accountability. Cooper's integrity and bravery fundamentally reshaped how corporate America approaches financial oversight. The WorldCom scandal stands as a stark reminder of the devastating consequences of corporate greed and lack of oversight. Its collapse, the largest bankruptcy in U.S. history at the time, spurred significant reforms aimed at increasing transparency and accountability in financial reporting. The story of Bernard Ebbers, from a humble bus driver to a disgraced billionaire, illustrates the corrupting influence of unchecked power and the immense pressure to maintain an image of success. It underscores the vital role of ethical leadership, vigilant internal auditors, and robust regulatory frameworks in safeguarding markets and investor trust. The legacy of WorldCom endures in corporate history.